Hello everyone, I hope so you will be fine. So today we are going to discuss cost of capital for new sources of finance. In the previous lecture, we discussed how to calculate the cost of capital for current sources of finance. So this cost of capital for new sources of finance is also called marginal cost of capital. So let me explain what is the marginal cost of capital first. So the marginal cost of capital, which is MCC, is the weighted average cost to the firm of the next dollar of new capital raised. Like simply, if you will raise a new finance, so what is the weighted average cost of capital for the new finance? Okay, that is what is your marginal cost of capital. So, as we know that when we want to finance our capital projects, so we may use retained earning also, but sometime retained earnings alone are rarely sufficient to fund all the corporation long-term needs. So maybe we need to go for issuance of new securities at some point, right? So that is why we are going to see how would you calculate the cost of capital if you are going to raise finance from the new issuance of securities. You may issue the debt, or you may issue the preferred stock, or you may issue the common stock to fund your capital project. Okay, and here we are assuming that the company will maintain its optimal capital structure. So I told you last time, optimal capital structure mean to say capital structure means a debt ratio equity, and optimal capital structure will be the capital structure where our WACC will be minimum. So although we are going to issue new sources of finance or new securities, so we will assume that we will maintain our capital structure here. Okay, so here we go. It's just a simple example because whenever we raise additional finance, so obviously it will become expensive as investor demand high returns to compensate for increased risk. So this is the point. Why? Because as we take the further even loan, or maybe if you will issue the common stock, right, or the preferred stock, so obviously the company will become risky, especially if you will issue the debt, right? And so the investors may demand high returns because they are taking high risk. So here we have a small example to understand the marginal cost of capital, and then we will see how to calculate the marginal cost of capital. Okay, so steps I will show you, just a general discussion first. For example, we are just taking example. A company has determined that it requires 4 million dollar of new funds to fulfill its plans. Like simply for capital projects, you need 4 million. So retained earnings of 1.2 million are insufficient. In simple words, we need, for example, 4 million total funds to finance our capital project, but we already have 1.2 million dollar. Okay, we already have from the retained earning, and obviously the deficit is how much? Because we need 4 million, but we already have 1.2 million, so the deficit is 2.8 million dollar, right? So this 2.8 million dollar, maybe we may take through the debt, or maybe we can issue the preferred stock or the common stock, or maybe the combination of all. Okay, so they're saying that the firm wants to maintain its capital structure, as I told you, its assumption of 10% long-term debt, 20% of preferred stock, and 70% of the common stock. Actually, these are the you can say the weight of source in the existing capital structure. Like in existing capital structure, we have a 10% from the debt, 20% from the preferred stock, and 70% from the common stock. Okay, so then the cost of raising the additional 2.8 million, that this deficit, which we are short with. So if you will raise this additional, okay, so what will happen? So this is what will happen here. So here I'm just showing you. For example, this is a small graph in front of you. So here we have a weighted average cost of capital. Okay, on this side vertically and horizontally we have a new capital raised. For example, at 1.2 million, let's assume, which is our retained earning, right? Maybe our cost of capital was here at this point. at this point. Okay, at this point, maybe our cost of capital was here, but now if you will raise additional 2.8 million dollar, so maybe it may increase the risk for the investors. So that is why your marginal cost of capital, so the cost of capital for additional sources of finance will be slightly higher than the current cost of capital. Understood? This is just a story, but now we are moving to the main point. So main point is this: how to calculate the cost of capital for new sources of finance. So guys, we will apply three steps again as we learned in the previous under the current cost of capital. So three step is what? Step number one, we will calculate the component cost of capital. Component cost of capital. Component cost of capital means, say, like, what if you are issuing the debt, so how you will new debt, so how you will calculate the cost of debt for that, for the new debt. Okay, what if you are issuing preferred stock, how you will calculate the cost of preferred stock, or if you are issuing the common stock, so how you will calculate the cost of equity for the common stock. Understood? So this is what we are discussing. This is what we will discuss. This is called component cost of capital. Okay. Like for the new debt, if you are issuing new debt or the preferred stock or the common stock, how would you calculate their individual source cost? Okay. And step number two, what you will do, we will calculate the weight, okay, of each source, so that I will tell you. And then the third, what? Third, we will calculate the weighted average cost of capital, okay, for the new sources of finance. Understood? So these are the three steps. So step number one, we are discussing how to calculate the component cost of capital. And mainly question will be about component cost of capital or for the WACC. Okay. So here we go. I'll show you the questions also. So this is what is we are going to discuss: how to calculate the cost of capital for new sources of finance. And the step number one, how to calculate the component cost of capital for the new sources. Okay, so first I'm assuming how to calculate the cost of new debt. Okay, cost of new debt. Cost of new debt mean to say, obviously, like, if as a company you are going to issue that debt, okay, to fulfill the need of your business. So how would you calculate the cost of debt? So please remember, for the when we calculate the cost of debt, okay, for debt, how you will calculate the cost of debt? This is the formula. So first you have to calculate annual interest in dollar, annual interest in dollar, and interest expense in simple words. How would you calculate interest expense if it is not given in the question? So you need, for example, if company is issuing the bonds, let's assume if company is issuing the bonds, so you need par value of the bonds times coupon rate. Okay, coupon rate, we know it is also called interest, stated rate. It is also called stated rate. Okay, par value we need. We don't need market value, or we don't need issue price. We need par value times coupon rate. So this will give you what? Annual interest in dollar. Okay, if you have a tax, so you can do it here. One thing, when you take annual interest in dollar, here you can do into one minus tax also, because interest expense is tax deductible. It can save you a tax. Okay, so anyhow, tax effect we can consider later, so you can follow this way. Simply take annual interest in dollar, which is par value times component coupon rate. So this will give you annual interest, and divided by net issue proceed. Okay, what is net issue proceed, guys? Net issue proceed. Don't take it here only issue price. Net issue proceed we need, because usually when we, for example, issue the bonds, so we incur flotation cost, right? Flotation cost means the issuance cost. So net issue proceed, this is how you will calculate. You will take bonds market price. Market price means the issue price here. Okay, if issue price is specifically is not given, so then you can assume that the bonds are issued at the market price. Okay, then market price you can use as a issue price. But if issue price is given separately, we'll take issue price minus flotation cost. Flotation cost means the issuance cost. So this will give you net issue proceed, and this you will use it here. net issue proceed. Okay, and then you will multiply with the 100. So this will give you cost of debt. Please remember, we have taken annual interest divided by net issue proceed times 100. So you got a cost of debt. So this cost of debt is the pre-tax so far. Now what I have to do, I can convert now into post tax. How I will convert into post tax? I'll take cost of debt which I have calculated here into 1 minus tax. So this is the one way to get the pre-tax by applying this formula, and then take that pre-tax into 1 minus t. And other thing you can do this way also. You can, when you calculate the cost of debt, so you have to take interest in dollar times 1 minus t. You can do this way also, divided by net proceed. Net proceed mean to say the issue price minus issuance cost. Okay, this is net proceed times 100. So this way you will also get the same answer. But otherwise what? Don't take the fact of tax here. Just take the interest divided by net proceed times 100. So once you got the answer, once you got the KD, then you can do into 1 minus tax. So this will give you also same answer. So whatever way you find it easy, you can use that one. Okay. Okay. Now here, please remember. Now also remember here, guys, sometime maybe in your exam question, maybe you are not issuing any bonds. He may tell you you are taking just a loan from the bank. So in that scenario, so we can also calculate the cost of that in simple way. So how? If interest percentage is given only in the question, he didn't tell you amount of loan, coupon rate, etc. Just he told you interest rate of the new debt. So then how you will calculate the cost of debt? If only interest rate is given, so then you will use cost of new debt. How? Simple formula: interest percentage into 1 minus tax. So this will give you post tax cost of debt. And we know for the WACC formula we need post tax cost of debt. I hope so it is clear, right? I'll do the question. So for just you have to memorize the formula. So this is our first priority, to use this formula if we can use, and get the pre-tax cost of that, and then convert it to post-tax. Other thing, if in the exam question only percentage is given, then take the cost of new debt, interest percentage minus into 1 minus t. Okay, so great. Then guys, now then we have a cost of new preferred stock. Okay, like if you are issuing preferred stock, right? So what will happen? So all new issues of equity securities involve the payment of flotation cost. Yes, although even you are issuing the preferred stock, so there might be a issuance cost related to that. Okay, so like maybe you are hiring broker like a bank. Which is called underwriter. Okay, so you may have to pay the fee to them. Maybe you have to pay to the some fee to the stock exchange. So there are flotation cost. Okay, so which reduces the proceed received. Yes, as we know, when we obviously, for example, if I'm issuing the preferred stock at $10, assume, and each dollar for each shares I'm incurring $1 flotation cost, it means my net proceed is going to be 9. So that is why thereby raising the cost of capital, because I will use this proceed, net issue proceed, to calculate the cost of that. Okay, so that is why, because my net proceed will be less if I'm paying flotation cost. So my cost of preference share will more, right? So how you will calculate the cost of preference share? Very simple formula. You have to just remember the formula. So please remember, for the preferred stock, never ever take the tax effect. Don't take it, because on the preferred stock we pay the dividend, and dividend is not a tax deductible. Okay, the dividend is not tax deductible. So how you will calculate the cost for the preferred stock? So this formula you will use. Cost for the preferred stock, new preferred stock, you will take next dividend. Next dividend means whatever dividend you will pay, divided by preferred stock market price minus flotation cost. Okay, please remember here, because divided by is what? Market price of the preferred stock minus flotation cost. Here I'm assuming market price is equal to issue price. Please note, if issue price is given in the question, so you will use the issue price. But if issue price is not given in the question, so we will assume that preferred stocks are being issued at market price. Okay, so that's why I'm using market price here, minus flotation cost. So this denominator, which is market price or issue price minus flotation cost, this is called what? Net issue proceed. Okay, times 100. So it's again, this is how you will get the cost for preferred stock. And I told you important note, the note is for the preferred stock we will not take the tax effect because dividend is not tax deductible. So this is what is the second formula, because quickly I'll complete the concept and we'll move to the questions and we will see how questions will be tested. Then how to calculate the cost of new common stock. Okay, so for common stock, so we know guys, please remember here, the cost of new, for the cost of new common stock, which model we are going to use? We are going to use dividend growth model. Okay, which is also called dividend discount model. Understood? So this model we are using in your CMA exam, and based on this model we will try to estimate the cost of equity, okay, for the common stock. Understood? And we know under the dividend growth model we assume that dividend will grow, okay, with constant percentage in infinity, and this we discussed in the last class. Same formula we are using. So how you will calculate cost of equity for the common stock? So this formula you will use. The formula is next dividend. Next dividend means say what? How you calculate the next dividend if it is not given? If next dividend is given, just use it. But if he told you last dividend, then you have to take last dividend into 1 plus G. G stands for growth. Okay, so this is equals next dividend. So next dividend divided by net issue proceed. And again, net issue proceed, how you will calculate? Market price of the stock, which I'm assuming issue price, minus flotation cost. So this is called net issue proceed. Okay, then plus growth rate times 100. So this formula we will use. And do you remember we discussed the similar formula in the last class also? So this is how you will calculate cost of equity for the common stock. And now one more thing, usually in the previous class I told you the cost of equity for the common stock, we will use the same cost of equity for the retained earning also. But today in in the cost of capital for new sources of finance, for retained earning there is a slight difference of formula. What is the formula for? So here please remember here, this is the formula here for the retained earning. The numerator is the same, only in the denominator we will use here, instead of issue net issue proceed, we will use here simply market value of stock. Okay, and then plus growth rate times 100. Why I'm taking market value only? Why I'm not taking net issue proceed? Okay, because net issue proceed equals market price minus flotation cost. Flotation cost we are ignoring in retained earning, because in retained earning we don't have any issuance cost, right? That's why simply here market value will divide. So this is written here for the retained earning. Next dividend, which is equal to last dividend into 1 plus G divided by market value of stock. Don't take net issue proceed. Plus growth rate times 100. Okay, so this is a slight difference here. Because why we are taking only market value? Why we don't take net issue proceed? Because we don't have any issue cost. I mean, say flotation cost for the retained earning. Okay, now here we have a small question. And weight, we know if you want to calculate the weight, how weight is calculated last time I have already explained. Same formula you will use for the weight, but I'll show you directly through the help of question example. And then the weighted average cost of capital step 3 we will also perform. So for example guys, let's assume we have a small example. They're saying a company's current capital structure is 10% debt, 20% preferred stock, and 40% common stock, and 30% is the retained earning. Actually, this is the weight is given. Okay, but weight if you want to calculate, so for example, if you want to calculate the weight for debt, so you will take value of debt divided by total value. Total value means all sources, okay, which may include debt plus equity plus preferred stock plus retained earning. Okay, for example, if I want to calculate the weight for retained earnings, I'll take value of retained earning divided by total value, which is the summation of total value is the summation of debt plus equity plus preferred stock, okay, plus retained earning, whatever you have, okay. So this is the formula of the weight when we calculate, but here weight is given straight away. He told you debt is 10%, preferred stock is 20%, common stock is 40%, and retained earning is 30%, although we have discussed how to find out the weight in the last class. Okay, so weight is given. So one thing is given. Now we have to look what is next. A company has determined that it requires 4 million of new funding to fulfill its plan. Okay, so 4 million is the total funds required. Retained earnings are sufficient to cover 30% of the firm's new capital need. 30% mean to say what? They are saying that, for example, we have a 1.2 million, it will be a 30%, right? So they're saying retained earning, we have 30% because here he told you retained earning are 30%. So let's assume if 4 million funds are required, so if we will take 30% of that, that will be 1.2 million. Okay, so that we have. So now again we need 4 million, but we have 1.2 million. So it means that shortage is 2.8 million. And now this how shortage we are going to cover. Here we go. So this is what they're saying. They're saying this shortage, which is 2.8 million. They're saying the rest must come from other three components of capital. Other components as what? Debt, preferred stock, and common stock. It means remaining funds, this 2.8 million, we have to take from the debt, preferred stock, and common stock. And please make sure, I told you the assumption is we will maintain this capital structure. These percentages will not change. Okay, we will raise the finance in such a way. Now here, so please remember, question continues. The company can issue new debt at a cost of 12.6%. So this is the percentage of debt. And no, please note it here. So if you will look at here, we are not provided with the amount of loan here. Simply he told you cost of debt percentage. I told you when only percentage is given. So cost of new debt, how you will calculate? You will take interest percentage, okay, into interest percentage into 1 minus tax. Okay, interest percentage is 12.6% into 1 minus tax. So tax, I believe, is not available in the question. So it means this is going to be your cost of debt only. Okay, because in this question tax is not available. But if it is there, so you have to take 1 minus t. So this is going to be your cost of debt. Okay, we'll see if the tax is there or not. So let me go through. I believe it's not there. So the firm can also sells $100 par value preferred stock that pays 14% dividend and has 5% a $5 per share flotation cost. Okay, so here we got what we got here, preferred stock data we got. So we can calculate the cost of the preferred stock. Do you remember the formula for the cost of preferred stock? I told you the formula is cost of preferred stock equals next dividend divided by net issue proceed, net proceed times 100. Okay, now dividend is not given straight away, but he told you it's a 40% dividend. So if you want to calculate dividend, so please remember dividend we will always calculate on the par value. So par value is $100, so $100 times 14%. So it means $14 is the amount of dividend per stock divided by net issue proceed. Net issue proceed you have to calculate how. So I told you net issue proceed you always calculate like this: issue price. If issue price is not given separately, so we can use market value minus flotation cost. So this will give you net issue proceed. Okay, so here we go. Flotation cost is given here. Issuance cost $5 per share flotation cost. So $5 minus issue price is what? Is there given issue price? $100 per preferred stock pays 40% dividend. Okay. Uh, issue price is not given. So it means we can again assume one more thing, that these stocks are being issued at par value. Understood? Because market value is also not given. So only par value is given. So here he told you, no, here he told you that company sells $100 par value preferred stock, and this is the flotation cost. It means we can assume now further that these stocks are being issued at par value. So 100 minus 5, so my net issue proceed is 95. So $14 divided by 95 multiplied by 100. So my answer would be, for the cost of preferred stock, it will be 14.7%. it is here. Okay, understood? Then we have now, we'll continue reading. So here we go. So we got two things. We got a cost of debt. Cost of debt is 12.6 because there is no tax effect. Tax is not there in this question. And cost of preferred stock, we got 14.7. And now I'll continue with the question. They're saying the 1.2 million balance of retained earning will be used. Okay, this he told you we will use. And the remainder will come from the issuance of common stocks. Whatever remainder amount is there, that we will take from common stock. The new common stock will pay. So this is the data for common stock now. The new common stock will pay an $8 dividend. Will pay. It means it's a future next dividend will pay. If it is last dividend, then you have to growth into that. But it is a future dividend already. Okay. They're saying that is expected to grow 2% annually. This is the growth rate that this dividend will grow by 2% annually. The company's common stock currently trading at $55 per share. So it means this is the market value, and the new issue will have $3 per share flotation cost. And now if you will check this data, we don't have specifically issue cost, issue price we don't have. It means we can assume the stocks are being issued at market value because market value is given. Now how you will calculate cost of common stock? So I'm just writing that formula now. Cost of equity for common stock. Cost of equity for common stock. For common stock, we are calculating. Okay. I told you we'll take next dividend, which is given here as $8. Okay. Divided by net issue proceed. So which is equals market value, which is equals market value minus flotation cost. So market value is how much? 55. Okay. Minus flotation cost is 3. So this is net proceed is how much? $52. So 8 divided by 52 plus growth. Growth is how much? 2%. So we can write it here 0.02, and then we will multiply with 100 final answer. Okay. So if you will solve this, so you are going to get how much? 17.4%. This is cost of equity. Okay. This is cost of equity for common stock. Do you remember how would you calculate cost of equity for retained earning? Tell me now. For retained earning, so just this will be the difference. Just we will ignore the flotation cost because retained earning is not having a flotation cost. So now this will be the formula. Next dividend divided by just market value, which is 55 or issue price. Okay. Plus growth times 100. So if you will solve it, so retained earning is going to be 16.55%. So this is for the retained earning. Okay, guys. Now we got component cost. And now weight is already given. So we know the weight is in the question is given how much. We have a 10% from the debt, 20% from the preferred stock, 40% from common stock, and 30% from the retained earnings. So now we'll calculate the WACC step 3. So this is how you will calculate the WACC. First we'll write the component. We have a new debt, we have a preferred stock, we have a common stock, and we have a retained earning. And then we will write weight here. Weight is given in the question I just shown you. I have shown you 10%, 20% for preferred stock, 40% for common stock, 30% for retained earning. And then these weights we will multiply with component cost of capital. And do you remember the component cost of capital for the debt? It was 12.6%. For preferred stock, it was 14.7%. For common stock, it was 17.4. And for retained earning, it is 16.6. Just we have worked with this, right? And now we will multiply these two things, weight with the component cost. And this is how you will get weighted average cost of capital. So now if you will multiply 10% times 12.6%, this will give you 1.26. And then 20% times 14.7%, you will get 2.94. And then 40% times 17.4%, you will get 6.96. Then 30 times 16.6%, you will get 4.98. And if you will now plug all these figures, so this is going to be your weighted average cost of capital. Okay, guys. Great. So now this WACC obviously we use in the net present value calculations to discount the future cash flows in the investment appraisal that we will see later. Okay. So now here we have one more summary, short summary. Please remember, sometimes they may ask you uh, about the debt financing. and equity financing, like their points. So you should remember these points also. Please remember control, which financing option will affect the control, is always attached with the voting rights, and common stock always having a voting rights, that is not having a voting rights. I hope so you remember, right? The person who is having more than 50%, he is the controlling entity or person of the organization, right? So who can have effect on the control? Debt financing, no, because that is not having any voting rights. Yes, equity financing, it's a common stock, yes, they affect the control, because if you will issue blindly the stock, your voting rights may change, you may lose the control over the business even. Okay, then cost of issuing, please remember, for debt financing we have a lower issuance cost always, and for equity financing it is, we are having a higher issuance cost, so that is why we say debt is cheaper and equity is expensive. Then effects on net income. Yes, that will have effect on the net income, because interest, right? When we produce the income statement, so we write sales less cost of goods sold equals gross profit, and then expenses. Under expenses, you write the interest. So it means if you will write more amount of interest, it may affect your net income. But equity financing is not affecting your net income. Why? Because on equity we pay the dividend, and this dividend we don't deduct as expense. It has no effect on the net income, right? Then dilution of EPS, like which financing will affect the, which financing option will dilute the EPS. EPS means say dilution, means say decrease the EPS. That financing, no, because for EPS, what is the formula? We know, we take net income minus preferred dividend divided by weighted average number of common shares outstanding, weighted average, right? So here when we issue the debt, so because I'm talking about dilution only, okay, so when we issue the debt, we don't have any number of shares here, right? But when we issue the equity, yes, so number of shares will increase. So your EPS answers may go down. Then effect on solvency risk. Solvency risk, ability to pay your non-current liabilities. So when we take the debt, obviously, guys, it may affect you. It may increase your solvency risk, right? So debt is having effect, but equity is not having, because how debt, because effect on solvency risk. Okay, solvency risk, like which financing increase the solvency risk. This is what it means here. Okay, so debt financing always increase the solvency risk, not the equity. Equity always decrease the solvency risk. Then tax deductibility of payment. Yes, on that we pay interest, and interest is tax deductible. Yes, but on equity we pay dividend. Dividend is not a tax deductible. So that is why, for from tax deductibility point of view, that financing is having effect of tax, but equity financing is not. Okay, so this is what is the short summary. Now we are going to go through some questions. So here we go, guys. I need your concentration. First question is on our screen now. A corporation has sold 50 million of $1,000 par value. It means 12% coupon bonds. So these are bonds. 12% is the rate of interest. Par value is $1,000. 50 million is total amount of loan. Okay. The bonds were sold at discount, and corporation received 985 per bond. Although the par value is 100, but we issued at discount. So that is for against each bonds, we received 985. The corporation tax rate is 40%. Okay, that's great. After tax cost of these bonds for the first year rounded to the nearest 100% is. So you have to calculate cost of debt. How would you calculate, guys? I told you, if you have information to calculate interest, etc., so then you should use the proper formula. And the cost of debt, you will take interest dollars divided by net issue proceed times 100. So interest dollar, how would you calculate? We have $1,000 is the par value, and coupon rate is 12%. So we'll multiply with the 12%, which is coupon rate. This will give you interest dollar. So that is going to give you how much? Just simply, if you will take, it is going to be $120, right? So interest is going to be $120. So you'll take $120. Okay, divided by net issue proceed. So net issue proceed is how much? Because we sold it for 985 and there is no issuance related cost are given. So we'll take 985 is net issue proceed times 100. So if you will take 120 divided by 985, so this will give you the cost of debt, but pre-tax. We didn't take the fact of tax. It is going to give you can just check, I'm not sure. I believe it is going to give you 12.18%. Now we can convert into post tax also. So post tax, how you will calculate? 12.18% into 1 minus tax. Tax is how much? 40%. So zero point 0.4. So 12.18% into zero point 0.6. 1 minus zero point 0.4 is zero point 0.6. And now if you will solve it, okay, so that is going to give you how much? 7.31%. You can check the calculation, guys. I believe 7.31% you will get post-tax cost of debt. Okay. Okay, guys. So this is 7.31%. Option C is the correct option. So now we'll move to the next question. Okay, so here we go. We got a next question on your screen. Okay. A profitable firm is reviewing alternatives to raise additional capital. Okay. It estimates that it can issue debt at a yield of 6%. Actually, it's a cost of debt. Or, like if you want to take a financing from debt, so cost of debt is 6%. Or alternatively, alternately issue preferred shares. You can issue preferred shares at a yield of 7%. It's actually cost of preferred shares. Okay, this is the cost of debt. This is cost of preferred shares. If the firm's marginal income tax rate is 37%, tax rate will affect only cost of debt, not the cost of preferred shares. Okay. What would be the cost for each alternative? Okay. So if you want cost of debt, so I'll take 6%, which is given here, into 1 minus tax. Tax is how much? 40% or 37%. So 0.37. So if you will solve 6% times this is 0.63, right? So if you will further solve, I believe it is going to give you 3.78%. You can cross check. And for the cost of preferred shares, it will be 7% pre-tax. You will not take any effect of tax. So it means, so what will be the cost for each source? KD for that will be 3.78%. And for cost of preferred share will be 7%. So I believe this option C is correct. Okay, yes. Understood? We got another question. Okay, so now we have here another question. A company is planning to issue additional shares of common stock. I'll show you more questions, guys. Don't worry. A company is planning to issue additional shares of common stock in a public offering. Okay, common stock you want to issue. So the current market price of the company's stock is 38. This is the market price. If issue price is not given specifically, we will assume stocks are being issued at market price, which is 38. Okay, and the dividend for the past year, this is not the next dividend, is the last dividend, was how much? 2.25 last dividends. If last dividend is given, so we know how you will calculate next dividend. Last dividend into 1 plus growth, this is equals next dividend, which is also called dividend in 1 year time under dividend discount model. Okay, this is the last dividend I'm highlighting. Don't forget we have to add growth. Okay, so because it's a last past year dividend. Okay, it was 2.25. A well-known investment advisory firm forecast dividend growth is 8%. This is the growth. I'm highlighting growth. Then and an investment bankers estimate that the flotation cost would be 6% of the issue price. Okay, very good. So this is the flotation cost, which we will use to calculate net issue proceed. Then what cost of equity should the company use? Okay, so we'll write the formula. This is the common stock. So we'll write it there first. Cost of equity equals, because last dividend is given, so formula is next dividend divided by net issue proceed plus growth times 100. So next dividend, how you will calculate, because last dividend is given, past year is given. So I'll take 2.25, it's point, okay, into 1 plus growth. Growth is how much? 8%, right? So 0.08 divided by net issue proceed. Net issue proceed, I'll take issue price minus flotation cost. Issue price specifically is not given, so we can use the market value, and we can assume stocks are being issued at market value, which is $38. And flotation cost is what? 6% of the issue price. So it means 6% of $38. So 6% of $38. Can you just work? If you will take $38 times 6%, it is going to be 2.28. And now plus growth. Growth is 0.08 times 100. And if you will solve it now, so you will get the answer. Okay, just I hope so you can solve it now. Like you will take 2.25 times 1.08. This will be numerator then. Okay, then 38 minus 2.28, this will be denominator. Then you first solve this, then add this, and then multiply with 100. So you will get the final answer, and your final answer is going to be 14.8%. Okay, you can just use your calculator. So then we have another question on your screen now. A corporation is, okay, next question. A corporation is selling 25 million of cumulative non-participating preferred stock. Okay, it's a preferred stock. The issue will have a par value of $65 per share. It's a par value with the dividend rate of 6%. This is a dividend rate, okay, of preferred stock. And we know when we calculate dividend, we need par value times dividend percentage. Okay. The issue will be sold to investors for $68. It's a issue price now, it's given. Okay, and issuance cost will be $4. This is the issuance cost. Cost of preferred stock to the corporation is, how you will calculate, because now I'll next question I'll show you about the WACC. Okay, so cost of preferred stock, I told you will take next dividend divided by net issue proceed, okay, times 100. So dividend, how you will calculate, so par value, which is $65 times 6%, this will give you dividend. Can you take, can you tell me how much? It is going to be 65 times 6%. It is going to be, no, it's not 65, 68, because the issue price is 68. Okay, 68 times 6%. It is going to be 4.08 as a numerator. 4.08. What will denominator? Issue, net issue proceed. A net issue proceed, how you will calculate issue price, which is 64 minus flotation cost, which is $4. So denominator is going to be 64. It means 4.08 divided by 64 times 100. Just check it. 4.08 divided by 64 times 100. So it will be 6.375% cost of preferred shares. So 6.37. So where is the answer? Or we made a mistake somewhere? There is no option. 6.3, not a close option. If you will, the issue will be sold to investors for 68 per share. So guys, actually, issue will be sold to investors 68. So I believe I have done the correct. So then what is the mistake here? Maybe this figure is incorrect. Oh, sorry. So I made a mistake here actually. What is my mistake? Because when we calculate the dividend, we need par value. Yes, this is what is 65 par value I need times 6%. This will give you dividend. Okay. And now if you will calculate the dividend will be 3.90. Okay, this is the mistake. I was thinking why it's not matching. So dividend you will always calculate on the par value divided by issue price minus flotation cost will be, which will give you net issue proceed, which is 64 times 100. Now you can check what is the answer. So we got 3.90 divided by 64 and multiply by 100. So it is going to be 6.09. Okay, 6.0909. So this is option A is the correct option. Okay, yeah, thank you. So then we have another question. So this is little bit, you have to understand this question, please. I need concentration. Okay, they're saying that, please, I need concentration. A company which has no current debt. Okay, please remember here. When we calculate the weighted average cost of capital, okay? So what we need? So we need, for example, if we have a debt, so we need weight for the debt into component cost, right? And then if you have a equity also, so we need a weight of equity into component cost. Okay, these answer you will get. This you will add. This is called your weighted average cost of capital, right? WACC. If you will add these two. Okay, now note here, if a company is not having any debt into capital structure, if you don't have any debt, you have only equity, so it means you don't, this line you don't have now, right? That you don't have, this cost of equity will become your weighted average cost of capital. Okay, this is what I'm trying to tell you. If you don't have a debt, so your cost of equity will become the weighted average cost of capital. But if you have debt also, then debt cost and equity cost will become your cost of capital. So here we go. Moving to the question. Okay. They're saying a company which has no current debt has a beta of 0.95 for its common stock. Actually, do you remember the beta we use in CAPM equation to find out cost of equity for the common shareholders? Okay. Okay. This is the beta is given with no debt. That we don't have. Management is considering change in the capital structure to 30% debt and 70% equity. This is what they are saying. We want to change it. We want to introduce 30% debt into the capital structure. This change would increase the beta on the stock of 1.05 because beta is risk factor as you introduce the debt. So beta is increasing from 0.95 to 1.05. Okay. After tax cost of debt will be 7.5. This is given after tax already. If you will take a new debt, so there is after tax cost of debt is 7.5%. The expected return on equity 16%. This is the cost of equity. Risk-free rate is 6%. No, this is expected return on equity. Okay, so 16%. Okay, so risk-free rate is 6%. Should expected return on equity, you can also assume it is a market return. Okay, and it's a cost of equity. We have to calculate cost of equity separately, but it's a return on market we can assume because in CAPM equation we need return on market. Okay, so risk-free rate is given here, so this is a return on market because expected return on equity, it's a return on market actually. Should the company management proceed with the capital structure? Okay, so now if you will look at the option, previously if you will read the question first, so you notice that previously you don't have a debt, only you have a equity, and cost of equity will become your WACC. Previously, if you have no debt, in case of no debt, so cost of equity will become your weighted average cost of capital. Okay, and once you will introduce the debt, so if you have a debt, if you have debt, so then debt cost plus equity cost will become your weighted average cost of capital. Okay, this is the main point. Now here, if you will go through the option, they're saying that should the company's management proceed with the capital structure change? So obviously the answer, there are option with no and yes, no and yes. Should we proceed with it or not? Please remember, if your new WACC, which we will calculate after that, is lower than the new WACC is lower than the old WACC, then we should proceed with the debt. But if new WACC is more than the old WACC, then we should not proceed. Okay, this is simple answer. So it means we have to calculate WACC. What was the old WACC? What was the new WACC? Because when we were not having debt, only cost of equity will become your WACC. So we should know what is the cost of equity at that time. So we will calculate now. So cost of equity. So because CAPM data we can use because risk-free rate of return kind of things are given. So we'll use the CAPM data. So guys, what was the cost of equity under CAPM equation? Risk-free rate plus beta into return on market minus risk-free rate. Okay. So risk-free rate is given as a 6% here. So it is 6%. So you can write it at 0.06. Beta, previous beta was 0.95 given here. Okay. And return on market, return on equity is given here, 16%. Okay. So 16% you can write 0.16 minus risk-free rate 0.06. And at the end you can multiply with 100. So this will give you cost of equity. And if you will calculate it, it is going to give you 15.5%. You can just recheck on your calculator. Okay. So now you have to calculate new WACC. This is the old WACC, old cost of equity, which is equal to WACC in case of no debt. It was 15.5%. Now you have to calculate new WACC. For the new WACC, we will write it here. This formula you will use now for the new WACC. Okay. I'm going to remove this thing. For the new WACC, how would you calculate now? So you will write it for sources. We have source, two source. We have now debt and equity. We'll write their weight. What are their weight? So here he told you the uh, weight will be 30% debt and 70% equity. Okay, I'll write this weight here. Debt is going to be 30% and the equity is going to be 70%. Then I'll multiply with their component cost. And component costs are already given. You don't need to calculate. After tax cost of debt is given here. After tax cost of debt is given here. Okay. So which is how much? Which is 7.5%. We'll take multiply by 7.5%. And now cost of equity you can calculate by using CAPM. Cost of equity equals risk-free rate because now beta has changed plus beta times RM minus RF. Risk-free rate is 6% 0.06 beta. Now the new beta after that is going to be 1.05. 1.05 into RM which is 16% minus risk-free which is 6%. So now if you will solve this, so how much you will get cost of equity, guys? Maybe it will be 16.5%. I'm not sure. Just check 16.5%. So we'll take multiply 16.5%. This will give you now average cost. If you will just multiply, okay. So you will take here tax is there or not? If tax, yeah, this is already after tax. We have already taken. So now can you multiply here, guys? So if you will take point, this is now average cost of capital. It will be. So just let me do it on calculator. So we got a 30% times 7.5%. It is going to be 2.25, the first thing. Okay. And second thing, 70% times 16.5. It is going to be 11.55. And now you will add. If you will add here 11.55 plus 2.25. So it is totally going to be 13.8%. Okay, total. So it means now previous WACC was 15.5 and new WACC is going to be 13.8. So it means we should take the debt, right? Because WACC is reducing. So answer should be in the yes. So either B or D. So let's have a look now. B or D. Yes, we should take debt because the weighted average cost of capital will decrease. Yes, correct. Is the answer. Yes, we should take that because the cost of equity capital will decrease. No, cost of equity has increased because previously cost of equity was 15.5. New cost of equity is 16.5. This is not correct. But overall WACC is reducing due to cheaper debt. So B option is the correct answer. Understood, guys? Okay, now I'm showing you one more question. Little bit slightly bigger question. So option B is the correct answer. Okay, guys? B. Now we got a slightly bigger question here and I need your concentration. So how it is going to work because maybe we have to do some reverse calculations as well. So here we go. So fact pattern like it's a data of question. Rogers Inc. operates a chain of restaurants located in Southeast. Okay, Southeast. Okay, the company has steadily grown to its present size of 48 restaurants. Okay, it's just a story. The board of directors recently approved a large-scale remodeling of restaurants, and company is now considering two financing alternatives. So you got two alternatives. So the first alternative, and here we got a second alternative. First alternative is what? First alternative is we can issue the bonds the bonds that would have 9% coupon rate and raised and reissued at their base amount would net, this is net amount, net 19.2 million after a 4% flotation cost. Okay, so this 19.2 million is the net amount after flotation cost. Can you tell me gross amount? What will be the gross amount? Because its net amount is given. So I'm just asking you because these things we need to do. Because I told you if net issue proceed how? We'll take issue price minus flotation cost. So this is net issue proceed, right? Understood? And he told you net issue proceed is 19.2 million. I want you to what is the gross proceed or issue price? And flotation cost he told you 4%. So I want issue proceed, right? It means I can assume this way that issue proceeds are 100%. From there, flotation cost are 4%. So my net issue proceed is 96%. So can I gross up this value now? This value can I gross up? Yes, I can gross up. How I can gross up? So I'll take 90.2 million, which is equals 96%. I want 100% value. I'll multiply with the 100. So this will give you, because the amount which is given, I'll divide with its own percentage and I'll multiply with the percentage which I want to find. So this 19.2 is equals 96% and I want to find 100%. It means my gross value would be how much? So 19.2 divided by 90.96. Okay, so 0.96. So it is going to be 20 million, guys. So gross proceed is going to be 20 million. Okay, 20 million. Then 4% flotation cost and net proceed will be 19.2. And 4% of this you can calculate. So it means 20 times 4%. So issue proceed is 0.8. So 20 million minus 0.8 equals 19.2. So equation we got. So gross proceed is 20 million. Don't forget. So I'm just writing it here 20 million. So gross proceed or issue proceed is 20 million. Okay. Understood? Okay. Then and this is the base amount also. Base amount means a par value. It's a par value as well because here he told you reissued at their base amount. Base amount means this is the par value also. Okay. Then preferred stock, second scenario, with the stated rate of 6% would yield 4.8 million after a 4% flotation cost. Okay, so same way we can calculate again this gross amount for that because this is a after 4% flotation cost. Again, issue price minus flotation cost equals net issue proceed or net proceed. So net proceed is given 4.8 million and flotation cost is 4%. So issue price we can calculate. Yes, same way we'll assume this is 100%. This is 4% equals 96%. So we can gross up again. So how we'll gross up? We'll take 4.8, which is equals 96%. So divide by 96 multiply by 100, I want to find out. So 4.8 divided by 96 times 100. So it is going to be 5 million. It means my issue proceed is 5 million. Okay, minus 4% flotation cost. 4% of 5 million will be 5 million times 4%. It is going to be 0.2. So that this is how we got 4.8 million net percent. So this is gross amount I'm just writing. Preferred stock stated rate 6% would yield 4.8 million after 4% rotation cost. It means here gross value or issue price is 5 million. Then common stock that would yield 24 million after 5% flotation cost. Can you just guys gross up this value also? We can gross up this value also. Again, it is after issuance cost. We'll write the question issue price minus flotation cost equals net proceed. If this is 100% and now flotation cost is 5%, okay, equals net proceed should be 95. And net proceed is given 24 million, right? Okay, 24 million is given. So we can cross up. So 24 divided by 96 and multiply by 100. Not 96, 95 because it's a 95%, right? So 24 divided by 95 multiplied by 100. So it is going to be 25.26 rounded figure. Issue proceed millions. Okay. And minus now 5% flotation cost. You can take 5% of this value. Okay. So times 5%. So flotation cost is going to be 1.26 million to 6 million. So now if you will take it rounding difference only, okay, 25.26 minus 1.26 equals 24 million. Okay, so here I'm writing gross amount also here. The gross amount is going to be 25.26, 25.26 gross value. Issue proceed. Okay, for common stock. Great, great. Now we got a second alternative. Second alternative, what? This was the all first alternative calculations. Okay. Second alternative would consist of a public offering of bonds. They're saying the second alternative is that we can issue the bonds that would have a 9% coupon rate and 11% market rate and would net 48 million after 4% flotation cost. Okay, so similar technique we can use to gross up also. Like 48 divided by 96 times 100. This will be gross proceed. Then here, guys, Rogers' current capital structure, which considered optimal. They're saying whatever current capital structure that is optimal. So consist of this. The weight is given out already. Consist of 40% long-term debt. This is weight of debt. 10% preferred stock and 50% common stock. Okay, so this is the weight. Weight is already given. You don't need to work. The current market value of the common stock is $30. This is the current market value of the common stock. And the company stock dividend during past 12 months was 3 per share. This is the past dividend, guys. Past. Okay. Investors are expecting the growth rate of dividend to equal to the historical rate of 6%. This is the growth rate. Roger is subject to the effective income tax rate is 40%. Okay. So this is information. Now assuming that after tax cost of common stock is 15%. Okay. So K is given, guys. You don't need to work. After tax weighted average marginal cost of capital for Rogers' first financing alternative consisting of bonds, preferred stock, and common stocks. Actually, the question is they're asking, can you tell us what is the weighted average cost of capital under the first alternative option? Under the first alternative option. Okay, this is the first alternative option, this data, only this data. Okay, so you have to calculate the cost of capital. And by the way, one thing please note, cost of equity is given to you. Cost of equity here has already given for the common stock. 15% is given. So it means now you have to work two things. What? You have to work because there are three sources, right? Under the first option. The first source is the debt. How you will calculate the cost of debt? Can you apply the formulas? I'll remove it, these things now. Okay. So I'll keep writing and removing so you should understand the things because data is here in front of us. So first of all, we have to calculate cost of debt, KD. For the KD, I told you formula, we have to take interest dollar divided by net proceed times 100. Interest dollar, how you will calculate? The par value times coupon percentage. This is interest dollar. And par value means a gross value. For the bond, it was 20 million, just we calculated previously. So 20 million times coupon percentage is 9%. So if you will just solve, this will give you interest dollar. Okay. So can you work? Can you help me? So it is 20 times 9%. It is going to be 1.8 million interest dollar numerator. Net issue proceed is given already because net amount is 19.2. So 19.2 million times 100. So it means now you can solve 1.8 divided by 19.2 multiplied by 100. So this is going to be 9.375%. So you can round it. Cost of debt is going to be, it's before tax, not after tax. So KD before tax is KD is, if you will solve this, so it is going to be 9.375. Okay. Now can you just convert into after tax? Yes, into 1 minus T we will do. So what is the tax rate? Look into the question. So tax rate where it is given 40%. So we'll write it in 9.375 into 1 minus zero point 0.4. Again 9.375. If you will solve this is 0.6. So if I'll multiply, so final cost of that is going to be uh, times 9.3, okay, 9.375 times zero point 0.6. It is going to be 5.625, or you can say 5.63 rounded figure. Okay. So cost of that we calculated, just cross check in the solution. Is it correct or not? So yeah, so 9.375 into this. So you will get that figure, right? It will be 5.625. Okay. So here I can write this figure directly here. 5.62563 or 5.63. So I am writing directly here 5.63. 5.63. Okay, this figure, cost of debt. Then similarly, you have to calculate cost of preferred shares. We'll go back. And cost of preferred shares, here we go. How would you calculate now? For cost of preferred shares, I told you we will take cost of preferred shares. We need next dividend divided by net proceed times 100. So next dividend. So here we go. Again, dividend is calculated on the par value. So here is the preferred stock data. So dividend rate is 6%, right? And par value we have just calculated. What was the par value? 4 point, it was 5 million. Yes, 5 million. So par value we have grossed up, right? Initially. So we'll take 5 million, which is par value. Okay. 5 million times 6%. So this will give you next dividend. 5 times 6%. It is going to give you 0.3 million divided by net proceed is 4.8 million and multiply by 100. So 0.3 divided by 4.8 multiply by 100. So it is going to be 6.25%. 6.25%. So just recheck it's correct or not. 6.25. Yes, correct. So now we have to calculate cost of equity is already given, which is 15%. We don't need to work. Otherwise, we can follow dividend growth model to work with it. So it's 15%. So now we can calculate the WACC. How WACC will be calculated? Cost of component, cost of capital we have calculated already. For that it is 5.63. For preferred stock is 6.25 and common stock is given. And now here weight is also given in the question. Just go back to the question. See weights are given, right? Where weight is here 40% long-term debt, 10% preferred shares and 50% common stock. So these weights we will write 40, 10 and 50. And now we'll multiply 40 times this, 10 times this, 50 times this. So you will get these answers. And if you will add all this is your weighted average cost of capital. This is going to be your answer. Understood, guys? I hope so, guys. It is clear, right? So see you in the next class then. Thank you so much.